Yo, what is up, everyone? My name is Dom, and we're here to talk about unusual options activity. All right, let's kick it off with the disclaimer. So, disclaimer: this video is for educational purposes only. The statements made in this programming are solely the opinion of the show and are not a specific inducement to make an investment. One must perform their own due diligence and realize that all investments carry risk. There's no guarantee of profit. All right, everyone. First one I want to bring up is ENPH Energy, ticker symbol ENPH. Now, this is a solar play here. I think they are mostly the they work with the technology, the semiconductors, the photovoltaic cells. So they don't really control solar farms. They're more behind the technology of the actual solar module. So, as you can see here, for these May 21st, 2021 calls here, so expiring in like a few weeks, you know, it's very short term, very out of the money, you know, not a whole lot of volume here, but there was some nice orders, and I thought these were interesting to bring up, and I actually jumped into these ones because of how short term they were and because of how far out of the money they are. There's about 3,200 calls traded here of these May 21st 145 strike call. Now, this stock is at about $136 a share. They're buying the 145 strike call. That is really far out of the money. Now, these calls are super expensive for some reason. The implied volatility is not super high, but the calls and the puts on this stock are extremely expensive. So as you can see here, what I did, so they were buying these super out of the money calls, which I would not recommend doing. That's not what I did. I shorted a put spread here. So what I did is I sold to open the 135 put, and then I bought to open the 130 put. So I shorted the 135 put, and I bought the 130 put. Now, as long as this stock stays above 135 by on expiration, then this trade is going to be profitable. Now, I collected about $2.20 to short that put spread, with the maximum of that put spread going to $5. So what I always say is, when you're buying spreads, you want to spend about 1/3 of the strike width. On this one, we are collecting almost 1/2 of the strike width. So I would not want to be paying out 1/2 of the strike width. I would rather short it and collect 1/2 of the strike width, because that is a great risk reward in my opinion. Now, that might be a little confusing, you know, shorting put spreads and everything. I haven't talked about that a lot on this channel, so I haven't explained it a whole bunch. So if you got any questions, you know, just leave a comment down below, and I'll do my best to try to re-explain that. It's kind of a confusing topic. I definitely recommend, you know, learning calls and puts before you get into, you know, shorting puts and calls. And I would never short any put or call naked. You always buy that lower strike to, you know, cap off your losses if the stock, you know, does take off to the downside. So now, you know, I like the chart here. You know, somebody's clearly buying the dip here. You know, this thing came down from about 230 down to 131. You know, we're pretty much at that 131 level. You know, might trade down a little bit tomorrow, but you know, I'm pretty confident in this one. You know, I like the stock, I like the company, I like the chart. You know, it's kind of looking a little weaker, but I think we can get a bounce off this 200-day, and we have some good support around this $130 level. So I like the chart, I like the stock here. So next one I want to bring up is Gap. Now, this is kind of one where there are some extremely short-term puts and calls getting bought here. You know, as you can see right here, you know, there's some nice volume and some really short-term calls here. But I saw some nice put trades here for these May 7th 35-36 strike. Now, you know, this thing was up about 10% at one point today, and that's when I bought the put. You know, it was up 10% on absolutely no news. So far the trade is working out for us. You know, it's closed up 7% pretty much on no news. You know, as you can see here, you know, you'll see that I went out a little further, so I'm giving myself, you know, a couple extra weeks here. You know, this thing is still going to move fast because it expires in a couple weeks. I don't really think it's necessary to get an option that expires this Friday. You know, it's really not a whole lot of time for that to work out. And you can see that I bought the 36 strike put and I sold the 32 strike put. So for ENPH Energy, we shorted the put and we collected the premium. Now we're going long a put, so we're paying out the premium. So when you're shorting, you're collecting. When you're going long, you're paying out. So for this one, this was a good risk reward. I think we paid about like $1.20 for this spread to go to $4. So as you can see, you know, that premium right there was about 1/3 of the strike width. So I bought the put spread in this case. So let's take a look at the chart real quick, kind of going a little long on this video. So, you know, Gap has had a huge run here. You know, this thing has just had a huge run. I'm not saying it doesn't deserve to be here, but, you know, it's kind of getting to this overbought level here. We're kind of seeing some resistance on this RSI here. You know, it seems to come up to this right, kissing the overbought level, and then kind of trades down. You know, if this thing has a down day tomorrow, I might even close the trade because, you know, I am pretty bullish on this. You know, I'd definitely close the trade if it gets back to the 50-day or, you know, down to like 33, 32 level. So, you know, this is definitely not a long-term trade for me. You know, quick in and out trade, you know, make a few bucks and get out. So thanks to everyone who's been subscribing. I really appreciate it. Make sure to keep the subscribing up, and we'll see everyone in the next one.